What is the balance of payments, BOP? The balance of payments, BOP, is a comprehensive record of all economic transactions between residents of a country and the rest of the world over a specific period, usually a year or a quarter. It includes transactions in goods, services, financial assets, and transfers. The BOP is divided into three main accounts: the current account, the capital account, and the financial account. The BOP must always balance, meaning the sum of all transactions should be zero. Types of BOP accounts. 1. Current account records transactions related to trade in goods and services, income, and current transfers. Components. Trade in goods. Exports and imports of physical goods, e.g., machinery, food, oil. Trade in services. Exports and imports of services, e.g., tourism, banking, insurance. Primary income. Income from investments, e.g., dividends, interest, and compensation of employees. Secondary income. Current transfers, e.g., 2. Capital account records capital transfers and the acquisition/disposal of non-produced, non-financial assets. Components. Capital transfers. Transfers of ownership of fixed assets, e.g., debt forgiveness, inheritance taxes. Acquisition/disposal of non-produced assets. Transactions in intangible assets, e.g., patents, copyrights. 3. Financial account records transactions involving financial assets and liabilities. Components. Direct investment. Investments in businesses or real estate that give the investor control, e.g., foreign direct investment, FDI. Portfolio investment. Investments in financial assets like stocks and bonds that do not give control. Other investment. Loans, currency deposits, and other financial transactions. Reserve assets. Changes in a country's foreign exchange reserves held by the central bank. How BOP is calculated? The BOP is calculated using the following formula: current account plus capital account plus financial account plus errors and omissions equals 0. Step-by-step calculation. 1. Current account. Calculate the balance of trade in goods, exports, imports. Add the balance of trade in services, exports, imports. Add net primary income, income received, income paid. Add net secondary income, transfers received, transfers paid. 2. Capital account. Calculate net capital transfers, inflows, outflows. Add net acquisition/disposal of non-produced, non-financial assets. 3. Financial account. Calculate net direct investment, inflows, outflows. Add net portfolio investment, inflows, outflows. Add net other investment, inflows, outflows. Add changes in reserve assets. 4. Errors and omissions. This is a balancing item to account for discrepancies due to incomplete data or measurement errors. Example: BOP calculation. Suppose a country has the following data for a financial year in billions of dollars. Current account. Trade in goods. Exports equals $500, imports equals $400 to balance equals $100. Trade in services. Exports equals $200, imports equals $150 to balance equals $50. Primary income. Income received equals $50, income paid equals $30 to balance equals $20. Secondary income. Transfers received equals $10, transfers paid equals $5 to balance equals $5. Total current account balance equals $100 plus $50 plus $20 plus $5 equals $175. Capital account. Capital transfers. Inflows equals $5, outflows equals $3 to balance equals $2. Non-produced assets. Acquisitions equals $1, disposals equals $0 to balance equals $1. Total capital account balance equals $2 plus $1 equals $3. Financial account. Direct investment. Inflows equals $50, outflows equals $30, to balance equals $20. Portfolio investment. Inflows equals $100, outflows equals $80, to balance equals $20. Other investment. Inflows equals $30, outflows equals $20, to balance equals $10. Reserve assets. Change equals minus $10, decrease in reserves. Total financial account balance equals $20 plus $20 plus $10 minus $10 equals $40. Errors and omissions. Suppose errors and omissions equals minus $2 to balance the BOP. Final BOP. Current account plus capital account plus financial account plus errors and omissions equals 0, 175 plus 3 plus 40 minus 2 equals 216. This should equal 0, so adjustments are made to balance the BOP. Why BOP must balance? The BOP must always balance because every transaction has two sides: a credit, inflow, and a debit, outflow. For example, if a country exports goods, credit, it receives payment, debit. If a country imports goods, debit, it makes payment, credit. Any surplus or deficit in one account is offset by a corresponding deficit or surplus in another account. For instance, a current account surplus is typically offset by a financial account deficit, capital outflow. A current account deficit is typically offset by a financial account surplus, capital inflow. Importance of BOP. 1. Economic health. The BOP provides insights into a country's economic health and its position in the global economy. A persistent current account deficit may indicate competitiveness issues, while a surplus may reflect strong exports. 2. Policy making. Governments and central banks use BOP data to formulate trade, fiscal, and monetary policies. For example, a current account deficit may prompt policies to boost exports or attract foreign investment. 3. Investor confidence. Investors use BOP data to assess a country's economic stability and credit worthiness. Conclusion. The balance of payments, BOP, is a systematic record of all economic transactions between a country and the rest of the world. It consists of the current account, capital account, and financial account, each capturing different types of transactions. The BOP must always balance, and it is calculated by summing up the balances of these accounts and adjusting for errors and omissions. The BOP is a vital tool for understanding a country's economic health and guiding policy decisions.